All right. Well, we're back now, and we just got done talking about current liabilities. The first current liability that we wanted to talk about was accounts payable. Then we talked about converting an accounts payable into a notes payable. And really, the only difference between an accounts payable and a notes payable is that an accounts payable is a verbal promise to pay, where a notes payable is a written promise to pay. And so, as we discussed, it's just the other side of the transaction that we learned when we did the chapter on accounts receivable and notes receivable. All right. In this case, we're the debtor. We owe money, right, to our creditors, people who lent us money. We also had a brief discussion about a discounted note, and so you should know how to calculate both the maturity value, the due dates, and the proceeds from various different notes. What we're talking about now is payroll and payroll taxes. So, as the employer, we're going to be hiring, all right, employees, and we're obviously going to have to pay them. Well, if we don't pay them, we owe them, don't we? That in itself is a liability. However, what we're really going to spend most of our time on are the different types of taxes that we're going to have to withhold and then ultimately pay to the taxing agency. And so in accounting, payroll refers to the amount paid to employees for services they provide during the period. A company's payroll is very important, right, for the following reasons. Payroll and related payroll taxes significantly affect net income of most companies. For a lot of companies, their payroll is their largest expense. All right, so we want to make sure that we get that right so that we properly communicate net income. Right. The next thing is payroll is subject to a lot of rules, okay, whether they're federal or state laws and regulations. Right? And so we obviously don't want to break any rules or regulations. Right? So it's important that we have a good payroll system. And finally, good employee morale requires payroll to be paid on time and accurately. All right, and so that might be an issue for a lot of businesses these days, because if we're closed because of the quarantine, all right, are we going to be able to pay our employees on time? All right. Well, know that there is a new program out there, part of the stimulus, which is payroll protection. Right, and you can actually apply for a loan to pay your employees. So salary is usually referred to the payment of a managerial or administrative person. All right, salary is normally expressed in terms of either a month or a year, whereas wages usually refer to the payment of manual labor. This differentiation is also referred to as white collar and blue collar employees. All right. The salary or wage of an employee may be increased by bonuses, commissions, profit sharing, or cost of living adjustments. So companies engaged in interstate commerce, all right, must follow the Fair Labor Standard Act. Okay, and as part of this act, all right, for any employee who is hourly, if they work any 40 hours within a given 7-week time period, right, that employer has to pay time and a half, right, or 1.5%, all right, of their regular hourly rate, right? And so you're probably familiar with that. If you work, overtime at your employer, they generally are going to pay you time and a half. This rule does not apply, all right, for salaries. This is only for hourly. Okay? Now, some employers do pay overtime, but usually if you're salaried, you just get what you get, all right? And usually, again, that's the white-collar people, right? The white-collared employees. Something interesting, California, the state of California, right? They actually have a rule. It's not a federal rule, but a state rule that basically says that, hey, if you have an employee that works more than 8 hours in one given 24-hour time period, you have to pay them time and a half, right? And so it doesn't matter if they only work 1 day a week, but that he works 9 hours that week, he's gonna, or that 1 day, he's gonna have to be paid 8 hours at his regular rate, and then his 1 hour of overtime at time and a half. And so we're going to run through this scenario, okay? We're the employer of John T. McGrath. He's a salesperson. We, just so you know, we are McDermott, all right? And so we're making the journal entries for McDermott, right? And so his regular salary, all right, or not salary, his regular wage, okay, is $34 an hour, all right? And any hours that he worked in excess of 40, okay, is paid time and a half, right, to meet that rule. McGrath worked 42 hours, all right, and so there's multiple ways you can calculate his overtime or his total pay, but this is a good method. I say that because when I was a student, I actually combined 2 different methods, and I got this problem wrong. All right, so I don't want you guys to get this one wrong. So what we're going to do is we're going to take the 40 hours, his normal pay, okay, times his, the 40 hours times his normal pay. Then we're going to take the 2 additional pay or hours, and we're going to pay them, 1.5 times, all right? And so, that comes out to be $51, right? So, 34 times 1.5 comes out to be $51. And we multiply that times 2 hours, okay? And that's how we get that 102. We add them all up, and we come up with 1,462. So what do we call that, 1,462? All right. In payroll terms, we refer to that as the gross. Okay. Because from this amount, we're going to deduct, all right, all of his withholdings. Okay. And so looking at deductions, all right, from employees' earnings, okay, the total earnings of an employee for a pay period, including any overtime pay, as I said earlier, is called your gross pay, right, or your gross wage. From this amount, we're going to subtract 1 or more deductions to arrive at the net pay. Net pay is the amount paid to the employees. And so that's the cash that we're actually going to be giving to our employees. All right, some of those deductions, all right, consist of federal income taxes, state income tax, local income tax, Medicare or medical insurance, and pension contributions. All right. And so I want you to know that in this example, really we're only going to be focusing on the federal income taxes. All right. So we're really not going to be doing these ones down here. Okay. Because each state is different. And so, in order to teach a particular state's, tax law, it would change for, depending on which state you're in. All right. And so we're just going to eliminate those. So employers normally withhold a portion of the employee's earnings for payment to the employee's federal tax. Right? And so know that the employer acts as the agent, right, of the IRS. All right. And so the money that they're withholding, right, is the employee's federal income tax. Each employee, all right, authorizes when you fill out your W-4 form. So when you got hired, all right, at your job, they ask you to fill out a bunch of paperwork. In that paperwork was this thing called a W-4. And basically what that does is it tells the employer, okay, that you're going to be taking so many different exemptions. Okay. The more exemptions that you take, the more money you're going to have as far as take-home pay. But let me caution you here, because if you don't have enough withheld, the federal government can actually penalize you, right, and charge you interest, all right? And so you kind of want to get in the ballpark. And it's funny because I actually just got off the phone with one of my best friends, Kurt Matsuda, all right, from Hawaii, and his wife is she works as a nurse, kind of like a doctor. It's like a physician's assistant or a nurse practitioner. All right, but she's super high up in her organization, so she makes bank. I think he told me last time it was over $150,000. Right, but they take 0 exemptions on their W-4, which means that they withheld the maximum amount, right, from her paycheck. By the way, he's a stay-at-home dad, right, so he homeschools their daughter. And he just told me that they got a tax refund of over $10,000. And I have tried to explain to him over and over and over that that's not really good stewardship of your money. See, when the IRS withholds money from you, they do not pay you interest on that. And if he would have properly filled out his W-4, okay, yeah, he wouldn't get this $10,000 refund, all right? In fact, you would want to actually have to pay when you do your tax return, all right? You might say to yourself, well, that's not good. I mean, I want to get a good refund, all right? Well, see, the deal is the IRS does not pay you interest on that money. And so throughout the year, you've been paying the IRS, and they're not paying you interest on that. If you would have properly filled out your W-4, okay, you would have gotten that money, all right? It's, it doesn't go to some, hole in the sky. You would have actually gotten that $10,000. And if you would have invested it, right, throughout the year, now granted the investment or the interest rates aren't great right now, all right, but you would have ended up with more than $10,000 because of the time value of money. We're going to talk about the time value of money in a next chapter or so. All right, actually, no, that's next semester. We'll talk more about time value of money. But so, I've tried to talk to him about this, and he just said, hey, you know what? That may be true, but I'm not disciplined to do that. If I've got the money, I spend it, right? And so this year, they're using their $10,000 in order to get a generator in order to provide electricity to their house when they have the rolling blackouts in California. Because he said every year they have that. And last year, they had the rolling blackout and lost over $400 of groceries, all right, because they spoiled. Whatever. The W-4 dictates how much is to be withheld from your pay. And so John T. McGrath, he filled this out, all right? And it doesn't show it, but I think he took one exemption, all right? And so the total number of allowances, all right, he took one, all right? And so based on this information, the employer then uses a table, all right, to figure out how much he's supposed to withhold from this employee's tax return. And so on the W-4, the employee indicates the marital status and the number of withholding allowances. A single employee may claim one withholding allowance. A married employee may claim additional allowances for a spouse. An employee may also claim allowances for each dependent other than a spouse, right? And know that you can actually take as many as you want, right? So, maybe you're single, you can actually take 3, right? However, as I said earlier, let me caution you, because if you don't have enough withheld from your pay, you may end up having to pay a penalty. And so each allowance reduces the federal income tax withheld from the employee's payroll. And the federal income tax withheld depends on the employee's gross pay and their W-4 allowance. Withholding tables are issued by the IRS, okay, and so this isn't something that you have to calculate, all right? They give you these tables, right? Each year, the amount of standard withholding allowance is determined by the IRS, all right, and so it's different for each one. For ease of computation and because the amount changes each year, we assume that the standard withholding allowance is going to be $75. And so, all right, John T., remember he had his gross earnings, all right, of $1,462, right, for the week ended December 27th. McGrath's W-2, all right, claimed that one that I had to put in there, withholding allowance of $75. So then, all right, we're going to look, all right, in his wage bracket, all right, and we're going to say, hey, we had his gross, subtract his allowance, and so we're going to be looking for this number on the table that is presented, all right? And so you can see that 1,387 falls somewhere, okay, in between the 767 and 1,796. And so I don't know if you've ever heard, and this doesn't happen as much anymore, okay, but back, when I was younger, I did literally hear somebody say this, where they were going to get offered a raise at work, and they said, I don't want that raise because it's going to put me in a higher tax bracket, all right? Because you can see that the tax brackets here are 10, 15, 25, 28, 33, 35, and 40, all right? Rounding, all right? And so he was just like, I'm not going to, I told them to take that raise and shove it, because it put me in a higher tax bracket. Well, that's just stupid, all right? Because we have what's referred to as a progressive tax. And so let me just choose a number, all right? Let me choose, all right, a wage of 7,600, no, I'm sorry, not 7,000, $768, all right? And so really what I'm doing is I'm looking here, all right? We have wages, okay, of $768. Well, basically what you're going to do is you're going to pay a tax of $17.90, okay, on that $767, and then you're going to pay 25% only on that $1. Okay? That $1 that exceeds this bracket. Okay? Does that make sense? It's progressive. And so basically the dude was giving away money, all right, back to his employer. Not smart, right? If somebody wants to give you a raise, you take that raise, all right? Because you're not going to, it's not that the whole amount is going to be taxed at 25%. It's just what's referred to as the incremental dollar. So hopefully that makes sense. But with our John T, all right, his falls in between this. And so this is how it's read. We're going to pay $99.65, all right, for the taxes up to, right, the $767. Then we're going to add 25% for anything that is in excess of the $767. All right, and so he had wages, okay, of 1,387. Okay, this number up here, okay, and we're going to subtract, right, the $767. Okay, that's this bracket right here, the low end of the bracket. Okay, it's the low end of the bracket. Okay. And so we're only going to pay tax of 25%, all right, on the difference, or the $620. So we're going to multiply that times 25%. Okay. And so we're going to take $99.65, and we're going to add it to $155. So let me write this out, all right? We had, all right, this amount up here, this 1,387. Okay. We subtracted from it, all right, the 767, okay, and that gave us subtract 767. Okay. That gave us $620, and we're going to multiply this times 25%. Okay. And we come up with 155. Okay. We're going to add to it then, all right, that 99.65. So we're going to have a total tax withheld of $254.65. Right? So that's the tax that we're going to withhold, or the employer is going to withhold from John T's payroll. And oh yeah, here it is. All right. So yeah, I mean we already did all those calculations. Next, all right, there is this thing called FICA tax. All right, it stands for Federal Insurance Contribution Act. All right, but what's kind of interesting about this is it's broken into two parts. All right, there's the Social Security portion. Right. Oops, let me do this. Oh, Let me erase all that. All right. I don't know why this, the Social Security portion and Medicare. All right. And so it's broken into two parts. Know that this has a cap, which means if you exceed a certain amount, you're not going to have to pay any more Social Security. This one does not. No cap. And this basically is a percentage of your earnings. And so the amount withheld from each employee is based on the employee's earnings paid in the current year. The withholding tax rates and maximum earnings subject to tax are often revised by Congress. All right. To simplify, all right, this chapter assumes that the following rates are subject to the tax. All right. For Social Security, it's 6%, and for Medicare, it's 1.5%. Know that the cap, right, I think the last time I looked at the FICA cap for Social Security, I think it was $118,000. All right. So in this scenario, just know that John T, even though he gets paid a lot, all right, he did not exceed the Social Security cap, because this is the last pay period in the year. I think it was December 27th, if I remember correctly. All right. And so he did not exceed the cap. And so all we're going to do is we're going to take, all right, his earnings, his gross pay, all right, and we're going to multiply it times the 6%. And so we're going to withhold an additional, all right, $87.72 for Social Security. We do the same thing for Medicare, all right, and so yeah, we're going to withhold a total FICA tax of 109. And so, about this time, I always ask the question, hey, do you guys think that Social Security is going to be around when you retire? Okay. The answer is, I believe yes. Because the truth is when I was a student, okay, somebody, in the Wall Street Journal had done a calculation that said, hey, the Social Security program will be bankrupt, I think it was by 2002. Well, obviously, all right, that has come and gone, and it didn't go bankrupt. You still have Social Security, but you need to know that Social Security is not a good retirement plan. It was never intended to be enough money to live on, all right? It is a supplemental retirement payment, all right? So do not rely on Social Security. You need to have a pension, all right? And we'll talk about that shortly. So other deductions, all right, employees may choose to have additional amounts deducted from their gross pay, right? Could be retirement savings, charitable contributions, or life insurance. Okay. Gross earnings less payroll deductions equal net pay, all right? So net pay. I don't know if you were like myself. When my first job I got out there, I was making a whopping $3.35. That was the minimum wage back when I was I think I was 15. All right. $3.35. All right. And so, I got my first job. I worked 10 hours and I'm like, woohoo, I'm going to have $35 and, whatever cents. And I got my check and it was like 20 bucks. I'm like, who stole it from me? I don't remember what it was. That was probably more than 20 bucks, but because that seems like a lot of taxes withheld. All right. But I did not understand the difference between gross pay and net pay. All right. The net pay is obviously, we've subtracted things coming down to your net pay. So net pay is sometimes referred to as your take-home pay. All right. So yeah, my whopping $20 for working 10 hours. So we're going to do that with John T. All right. And so he had his gross pay, and now he has his net pay. All right. From his gross pay, we subtracted his federal income tax, all right, his Social Security, his Medicare, and then these are ones that we did not discuss. He had retirement savings of $20 and the United Fund of $5. All right. So his total deductions were $389.30, bringing his net pay then down to $1,072.70. This is the cash that he's going to get, or that we're going to record as the payment to John T. So there's generally, when it comes to payroll, you need to understand that there's the employees side of things, and then there's the employer's side of things. Right? And so when we're talking about the liability for the employer's payroll taxes, right, you need to know that the employer, they have to match the FICA that the employee paid in. All right, so that calculation, unfortunately, I erased it from my calculator, that we had done earlier, the Social Security and Medicare added together, the employer has to also, pay that amount into the federal government. They're also going to have to pay the FUTA and the SUTA, right? And so this term FUTA, okay, stands for Federal Unemployment Compensation Tax, and then the SUTA, okay, is the State Unemployment Compensation Tax. Right? When we're talking about those two things, all right, what we're talking about is unemployment, right? And especially in these times, understanding unemployment is probably pretty important. So if you've been working at a factory, especially, all right, and because of the coronavirus, they have to lay you off. You have the right to go and, file for unemployment, okay, which is going to be a percentage of your pay, all right, so that you don't starve to death, all right. Know, okay, that is generally paid, okay, your unemployment is paid by the state. And so while you have been working, the employer, not the employee, but the employer has been paying into a fund, all right, at the state, okay? And so the state has this money that has been accumulating, and whenever there's a downturn in the economy or weird things like this happen, right, then the state will pay the people who have been laid off. Now, know that a lot of times, there's a lot of rules and regulations, all right, that go behind that. Right? But it's the state who pays the unemployment checks. And so really the question is well, what is this federal part? Okay. Well, the federal part, as you'll see, it's a really small percentage compared to the state unemployment. And that is paid to the federal government because they're the ones that administer, okay, this program. And so there's two parts. This is only paid by the employer. The employee does not pay FUTA or SUTA. And so here's a good visual, all right? And I'm pretty sure there's a multiple choice question that asks who pays what, all right? The employee, they pay Social Security, all right? They pay Medicare, and then the employee's federal withholding. As far as the employer, they match the Social Security and Medicare, but then they also pay the FUTA and the SUTA unemployment tax. And so, all right, in order to track all of that, okay, it's imperative that you have a good payroll system or an accounting system to be able to do this. A lot of businesses, just so you know out there, they utilize services, all right? So a very common and large payroll service is called ADP or ADP. And so they would actually do all paperwork for you, and you just have to cut them the check, right? However, you need to know how to calculate all of this. And so a payroll system, right, should be designed to pay employees accurately and timely. And they want their money, right? It meets the regulatory requirements, and so that we can use the information, right, to make decisions. Although payroll systems differ among companies, the major elements of payroll are pretty much the same. You have a payroll register, right? You have an employee's earnings record. This is kept at the HR's office, okay? And then you mail or direct deposit the payroll check. So the payroll register is a multi-column report used for summarizing the data of each payroll period, right? And know that it's useful to actually have a separate checking account, right, just for payroll. So although payroll registers may vary, okay, they're all going to have some components here. You have to have the name, the total hours worked, regular earnings, overtime, gross earnings, Social Security, Medicare, federal income tax, other withholdings, net pay, right? The check number that we use to pay that, right? And the accounts that we're going to use to record that. And so if you end up taking Excel, all right, Excel, one of the comprehensive problems is actually coming up with a payroll register, right? And so here's an example, right? And unfortunately, it's broken into two sections only because we don't have enough space, all right? And so this, all right, carries over and is tacked onto here, all right? And so we had our John T. McGrath, all right? Here are the hours that he worked, okay? His regular pay is overtime, so we added it up, all right? And so this is his gross pay, right? Okay. From that, we subtracted the Social Security, the Medicare, the federal income tax, all right? His retirement, miscellaneous, okay? So here's his total deductions, and here is his net pay. We used check number 6860, okay, to pay him, and we count him as this sales salaries expense. And so, as you've been doing your comprehensive problem, all right, you've basically been journalizing, all right, the sales salaries and office salaries expenses for your company, all right? And you would have pulled it off of this table. And so from this payroll register, we're able to pluck off, all right, all of the numbers we need to make the journal entry. Right? So take note, here's our 13,902. If you add these up together, 13,902. Then we have all the deductions. I want to highlight, right, that this is a liability. 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 What's this chapter on? Current liabilities, isn't it? See, we don't, as the employer, we don't get to keep that money, right? We got to mail the stuff to the state. We got to mail the stuff to the federal government, all right? And we ultimately are going to have to pay our employees, okay, their net pay, okay, of $8,329 or whatever that is, 327. So payroll taxes are recorded as liabilities, all right, when the payroll is paid to employees. In addition, employers compute and report payroll taxes on a calendar year basis, which may differ from the company's fiscal period. And so on December 27th, McDermott, okay, that's us, all right, has the following payroll data. All right, we have our gross pay, okay, we have all the different deductions, okay, and we end up with, okay, yeah, they're just showing us the calculations for the payroll tax for the employer side of things, right? And so the employer is going to journalize, right, this payroll tax. And so the journal entry, okay, is going to be payroll tax, right? And then we matched the Social Security and the Medicare. Meant to do that in red. Okay. All right, we matched this and this, okay, and this is only the employer pays the SUTA and the FUTA. And so that brings me to this little discussion, right, of the differences between an employee and a subcontractor. Because unfortunately, there are some employers out there who are unscrupulous, right? And if they can report you as a subcontractor, okay, they can save this $1,205, because as an employer, we had to pay this. But if we hire people as subcontractors, we can get out of paying this payroll tax. Now, know that there are some specific rules, all right, that require employers to record employees as employees or different as a subcontractor. And so if you ever want to know the specifics behind that, if you go to irs.gov, right, and under the search do 1099 versus W-2, right, you can actually, there's the specific rules and regulations. Because here's the deal. If you, all right, receive at the end of the year a 1099, okay, that means that your employer has been treating you as a subcontractor. Right? They're doing that in order to save this $1,205, okay? But it could be illegal, right? Because again, it's unscrupulous. If you are in that situation, I would definitely look into it, because if you are a 1099, you have to pay both sides of Social Security and Medicare, right? So the federal government require, this times two, don't they? Okay. Where the employee pays part and the employer pays the other part. If you're a subcontractor, you pay both parts, okay? And you can actually, financially get into a predicament if you do not pay that. The IRS can come after you and penalize you. So, employee's earnings record. Right? This is different from the payroll register. This is the detail that the HR department is generally keeping for each employee. Right? So each employee's earnings to date must be determined at the end of each payroll period. Okay? This total is necessary for computing the employee's Social Security tax and employer payroll tax. Thus, a detailed payroll records must be kept for each employee. This record is called an employee's earnings record. Again, there's a lot of important information, right, recorded on this, right, like the Social Security number. Oops, do that in yellow. Okay. And so this is kept by the HR department, and it basically shows all the hours that John T, right, this is John T. McGrath, right, that he's worked throughout the year, okay, and his total compensation, right, and so his total compensation this year was a nice fat $100,500. Pretty nice, right? For a salesman, that'd be great. And so again, this is all very confidential information. Should be kept separately from the accountant's records. At the end of the year, okay, because remember he made this $100,500. We're going to have to file, the W-2. So if you've ever had a job, you are familiar with a W-2, okay? And that is going to be taken from the employee's earnings record. And so you can see here, we have our $100,500 or $100,500 earnings. We have the federal income tax that was withheld. We have the Social Security that was withheld, or I should say those are the earnings, same number here. We have our Social Security that's withheld, Medicare, and then down here, would be all the state stuff. We didn't do the state because of the reason I explained before. Payroll checks. A company pay employees either by electronic fund transfer or by issuing paychecks. With electronic fund transfer, the employee's net pay is electronically deposited into their bank. And so if that's the case, there really is no liability for that, because we would have already recorded that as a payment. Right? Each payroll check, includes a detachable statement showing how the net pay was computed, which is typically identical to the payroll statement accompanying electronic fund transfer. And so here's an example of a payroll statement. So, if you're waiting on your employer to send you your W-2 at the end of the year, but you're really chewing at the bit because you want to get your refund for your income taxes, you can actually use, because take note, this is the last pay period, right? And it has, all the pertinent information, that we need in order to file our individual tax returns. There's your federal income tax, there's your Social Security and Medicare. I'm sorry, those are not. Okay, I didn't look at that clearly. We have our Social Security and Medicare. So we could use your last pay stub, all right, or payroll statement in order to file your taxes early. Most companies use a special payroll bank account, all right? So I had mentioned this earlier. An advantage of using a separate payroll bank account is that reconciling the bank statement is easier. Okay? In addition, the payroll bank account establishes control over the payroll checks and thus prevents theft and misuse. With utilizing a computerized payroll system, obviously we love computerized information. Um, so it inputs into the payroll system. I know that QuickBooks actually, you have to pay extra for it, but it actually do all these calculations for you. All right, and so the constants, you're going to have the employee name, social security numbers, marital status, rate of pay, tax rates. Okay, the things that are going to fluctuate are the number of hours or days, right? Accrued sick leave, right, and total earnings to date. Internal controls over payroll system. Some example of payroll controls include the following, right? Check signing machine, all right, instead of somebody doing it by hand. The hiring and firing employees should be properly authorized and approved in writing. All changes in pay rate should be properly authorized and approved. Employees should be observed when arriving for work to verify that the employee is actually there and is actually a legitimate person. Payroll checks should be distributed by someone other than the supervisors. Right? Again, making sure that they're a real person. And a special payroll bank account should be used. All right, we're going to stop there and we'll pick up the third part that deals with employee fringe benefits.